since there's only a few of us, I would definitely, as interactive as you want, we don't need to necessarily stick to the slides. If you guys have questions that are going on, the packet is there for you guys to take home. So just so you're aware. So my name is Jessica Windhausen. I am the Key at Work and HSA coordinator for KeyBank. So I work directly with our branches to help provide financial education for companies and enroll employees in health savings accounts. And this is Renee.
I'm Renee Bristone. I'm the branch manager of our Nottingham office here in Syracuse. Vice president with the bank as well, but one of the things that Jessica said is we're really trying to help our small businesses and our individual clients as well understand that there's benefits that as employers you can get from KeyBank and not have to pay for it. So there's some nice benefits if you work with a bank or enroll in our Bank at Work program that allows your employees to get benefits that you don't have to pay for. And the HSA is one of them. So it's important to really educate them on what's available.
So how many of you currently offer a high deductible health plan for your insurance? Okay. So as we go through this, you may have questions specific to what you're offering now or how to get employees more engaged. Just stop me at any point. I'm more than happy to answer your questions because some of this is going to be a little bit basic, but also to see explaining the value to your employees of a high deductible health plan. So there's 3 different health insurance options. There's the copay plan, high deductible plan, and a hybrid plan. Typically, a lot of companies have been offering a copay plan for years because it's what comes across to the employee as the most beneficial to them. A lot of times they will pay very high premiums, but when they go to the doctor, they're going to just pay a simple $10, $15, $20, or even $30 copay visit versus the entire doctor bill. So in an employee's mind, they're looking at that like, this is great. A lot of times they have a tendency to forget what may come out of their paycheck week over week, but they're thinking when they go to the doctor, I only paid $30 to go to the doctor. So this is the standard plan that a lot of companies are using. However, with the Affordable Care Act and insurance premiums going up, a lot of companies are having to explore other options. So what a high deductible plan is it's basically, a lot of people code it as a catastrophic health insurance plan because it's not where an employee is going to pay a small $10, $15, $30 copay when they go to the doctor. It is inexpensive for them as far as when it comes out of their paycheck. They're not going to pay as high a premium that's out of their paycheck, but it's not going to cover all of their medical visits in full. So instead of them going to the doctor and paying $30 when they go to visit, they're going to end up getting a bill at the end for whatever the health insurance plan will cover, well, whatever the doctor's negotiated rate with that health insurance company is. So a lot of times, you know, a regular visit to the doctor may cost them, say, $150 if it's a sick visit. The nice part about a lot of high deductible health plans is, well, visits are covered. So if you've got an employee, in their mind they may be thinking, I've got young kids, I can't do a high deductible health plan. If you've got an infant, you actually may be at the doctor every 3 months or 6 months or whatever the case may be. But most of those visits to the doctor are well visits. They're actually not going to pay for that. The insurance is going to cover that in full. Whereas if they bring their daughter or son to the doctor for every little sniffle, yes, they will pay for that because typically the high deductible plans will cover those wellness visits but will not cover sick visits, and that's when they'll get those doctor bills mailed to them. So for 2015, the minimum deductible for a high deductible plan is $1,300, and for a family it's $2,600, and that's what makes it be considered a high deductible health plan. The other option that is out there is what's called a hybrid plan, and a hybrid plan is going to combine the traditional copay plan with a deductible, but the deductible is typically lower. So you may pay $30 when you go to the doctor after you meet a $500 deductible versus that $1,300 deductible. So what I wanted to go over is like a cost comparison, because also from the company's aspect, you've got to think about how much it's costing your company. So I took 2 different plans, and this is based on third quarter's rates, so keep in mind it's probably gone up since then. So if you were to do a copay plan For single coverage, a company is gonna pay, well, the total annual premium is gonna be around $7,500. And for family coverage, it's around $21,000. And if you were to do a high deductible plan, you've got about a $6,000 cost for single coverage and $17,000 cost for family coverage. So you can see that there's a significant difference in what the annual premiums are for those two different plans. Typically, on average, companies contribute 70% of their employees' insurance. Sometimes it's higher or lower. So on the company aspect, you're paying for a copay plan about $5,200 a year for single coverage and almost $15,000 a year for family coverage. And for the high deductible plan, it's about $4,200 and $12,000 for family coverage. So you can see there is a good amount of cost savings from the company's aspect as far as that goes. So for single coverage, if you were to offer your employees a high deductible plan, you can save about $1,200 a year in premium expenses, and for family coverage, it's almost $3,000. Now to think of it on the reverse side, your employees are also going to have savings. So if they're taking, they're paying that remainder 30%, they're going to have less deducted out of their paycheck week over week. And if you find a high deductible health plan where all of the well visits are, any preventative medicine or well visits are covered, in the end, if they don't have a chronic illness, or they're not, let's call them hypochondriacs, where they're going to the doctor every other week, it's really not going to hurt them that much to offer them the high deductible health plan. The one thing I will say in what I do is I have noticed a lot of companies over the years trying to offer 2 different or possibly 3 different types of plans. One, a traditional copay plan, the Cadillac of plans where the premium is a lot higher, and a high deductible health plan. And I think it's great to start with to show your employees the 2 different options that are out there and available to them, and allow them to make the choice. Because then if you do have an employee that has a chronic illness or something of that nature, they're able to choose the plan that is best suited for them. The other thing I will let you know is that you are able to structure how much you as a company are paying of each of the plans that are offered. So say for instance you want to offer a high deductible plan and a copay plan. As a company you can say, I will only pay 50% of the copay plan, but I'll pay 90% of the high deductible plan to make it more enticing for your employees to go one way or the other. So that's another thing from the company aspect that you could look at. So if you were to offer a high deductible health plan, how could you use your savings? I know just downstairs we talked about wellness programs and how they may not all necessarily be the best, but that's one thing you would be able to offer to your employees is some sort of wellness program, or to dedicate more money to doing something to allow your employees to engage more in being healthy. You could save your costs for future benefits, future benefit costs as the rates continue to go up. You can also consider offering your employees a employer contribution into the health savings account. So how many of you that are on the high deductible health plan currently offer a health savings account? So one of the things that I think is really important when you're offering your employees a health savings account is to make sure that they're educated, not only on the high deductible health plan, but what the health savings account can do for them. Because a lot of times employees think that in their mind, you're changing their medical coverage or maybe taking something away from them. But a health savings account can really offer them a lot of benefits for now and down the road in the future. So the health savings account is basically a tax advantage account for the employees that they can use to save for qualified medical expenses that a high deductible plan doesn't cover. A health savings account you can pretty much use for anything that has a prescription associated with it. So doctors are very aware of that, so a lot of times they will now write prescriptions for items that you can get over the counter. I know when my daughter was sick and I took her to the doctor and they prescribed Motrin. So in my mind I was thinking, okay, there's prescribing Motrin, it's got to be the higher dosage of Motrin, and it was actually the same Motrin that I could have went right into the grocery store and purchased on my own. But now that they gave me that prescription, I can use my health savings account for it. The health savings account does cover dental, so if you don't have a dental plan for your employees, that's another option because they would be able to use this money for any sort of dental work that they need done, braces. The one thing I will say is the health savings account does not allow for any cosmetic surgeries, so whether it's, Botox or whether it's cosmetic dental surgery, you cannot use the health savings account for that. But psychologists, psychiatrists, physical therapy, all of those things you can use the money in the health savings account for.
Eyeglasses, contacts, I mean, that's a big thing too. Is being able to have that, the eye coverage as well.
So anyone can open an HSA as long as they are covered under a high deductible health plan. They don't have any other medical coverage. They're not enrolled in Medicare, and they can't be claimed as a dependent on someone else's tax return. And like I mentioned, the individuals are able to contribute to the health savings accounts as well as the employers. Every employer can make their own decision, so it's not a standard rule across the board whether you need to contribute to your employees' health savings account or not.
The other thing there is that those contributions come out pre-tax. So that's important too, is that their money's coming out before taxes, so they have less tax on their paycheck.
So for 2015, there are tax limits on how much you can put into the health savings account. So for 2015, it was $33.50 for single coverage and $66.50 for family coverage. However, anyone over the age of 55 can contribute an additional $1,000 into their health savings account each year. Yes?
Is that per person for couples?
No, an HSA is an individual account.
Like an IRA. So if you,
So how can you have family coverage?
Well, you have family health insurance coverage, but your HSA is a sole account. So for instance, in a situation where a husband and wife, like I have an HSA, it's in my name, but I've issued my husband a debit card off of my HSA. But it doesn't mean that, so I can contribute up to $66.50 because we have family coverage. If my husband and I were both over the age of 55, it doesn't mean I get to contribute $2,000 more. I only get to contribute that $1,000 for me being over 55.
but if you're both in a high deductible plan, you
He
can
could have
each
his
have your
own
own HSAs and contribute that amount.
The maximums include the employer contribution?
Yes, it does. So if as an employer, your employer gives you, say, $1,000 a year, you've got to bump all those numbers down. So that's the one thing I always try to make sure employees are aware of. Because some, like Renee mentioned, and we'll go into a little bit more, is there are tax benefits to it. So for some people, it makes sense to put as much money as they possibly can in an HSA, but you've got to take into consideration what your employer is giving you in that. So this is basically what a lot of people think as far as HSAs or high deductible health plans, is that your employer is taking things away from you and you're losing benefits. But realistically, with the health savings account, the one thing I'd like to point out is a lot of people offer HRAs or FSAs, and those are great, but it's a use it or lose it situation. So if you don't use your money by the end of the year, guess what? It's gone. The very nice feature about the health savings account is you're able to roll that money over year over year over year. So if you're in a financial situation where you don't need to use the money, you can save this money for when you're retired or when, God forbid, something medically happens where you need to tap into that money. So that's a nice thing for employees to know in their minds, and I think the biggest thing that I like to do when I'm out talking to employees is make sure they're aware. It's not a use it or lose it. So if you put your $25 in a paycheck, and at the end of the year you were healthy for the whole year and never needed to see the doctor, that's okay. Now you've got a little bank built up in there that next year when someone breaks their arm, you can access that money. So that's a nice feature. And a lot of health savings accounts do offer an investment option. So what your employees can do if they're able to is they can maximize what they're putting in their health savings account year over year. Every company has a different limit, but once they reach that limit, they can then invest the money. And it's similar to a 401k. So a lot of the funds that they're able to invest in are very low risk. Or if they want to be more aggressive, they can. Each employee can set that up. When they retire, they ultimately, if they choose to, instead of using this HSA funds for their medical expenses, they can use this as an additional 401k or retirement plan. They can take out the money and they can purchase, go on a vacation, they can use it to pay their expenses that they may have that Social Security isn't helping them cover, whatever their scenario is. The catch is if it's not used for medical after they turn 65, it's taxed as income. But if it's used for medical, they have no tax implications whatsoever after 65. So it's kind of a nice additional slush fund if there was something they wanted to do once they retired that their other funds can help them do.
And the other thing to remember with that is that the HSA goes with them. If they change employment, that's their account. So if they then work for another company that has a high deductible plan, they can just continue to use their own HSA and get it in there. So you don't have to, it's not, if they sever employment with you, that it's your money or it's their money, it goes with them wherever they go.
So what if you change jobs and you're not into an HSA plan?
Yep, so what happens if you change jobs is you're able to still use the funds in the HSA for medical expenses. However, as soon as you stop being on a high deductible health plan, you are no longer able to contribute into the HSA.
So you can't, okay, so you have to
Can't
use
put
it.
any more money into
Right,
it, but
okay.
you can use it.
Could you still invest it?
Yes. As long as you have that, like, if you've got, say, $10,000 in your HSA and now all of a sudden you are not on a high deductible plan, you can still invest that money. As long as you're not contributing anything more, there's no tax penalties for it.
So if I'm with a company now in our HSA, say through KeyBank and I have Excelis, but I move somewhere and their HSA is through Empower and I have United Healthcare, do I have to move banks
No.
or
No and
start
yes.
contributing?
So no and yes are the answers. Companies are able to say, you only can have your HSA if you want a company contribution through XYZ Bank. They are legally able to say that. So if you went to that second company and they said your HSA has to be through Empower if you want our money, then ultimately, yes, you would need to transfer your HSA to Empower. However, if the company is not doing a contribution, or if they're willing to deposit to multiple banks, no, you do not need to move your HSA. The one thing I will say is you cannot have two HSAs at once. So you cannot say, I want to keep this one at KeyBank, and I want to open this one at Empower. It will not, that's an IRS violation.
I was gonna say, that's federal, that's.
Yeah, that's the government. You can't control that.
And you can move it, no penalty, from one bank to another, as long as it's HSA qualified.
No IRS penalty, but unfortunately, a lot of banks have fees to transfer. So there are ways to get around it. So if you have an online bank for your HSAs, you're going to have a fee. There's really, quite honestly, there's no way to manipulate around that. If you have an Empower and a KeyBank, you are, as an employee, able to go into Empower and say, I want to close out this HSA, get a check, and as long as you bring it to KeyBank within 60 days, no tax penalties, and you didn't have to pay Empower a fee. At the bank, we are able to just submit a form to Empower to transfer to KeyBank, and with that scenario, Empower is always going to charge a fee. So it really depends on your employees, and one thing I do is I always offer that. Like, me personally, I would rather pay the $20 or whatever the fee is to Empower than have to take a physical trip to Empower, close it out, and bring it to KeyBank. But some people, that $20 is too important to them to give it up. So it really, I offer it to the employees, which way they wanted to proceed, and I would make sure I knew, this is exactly the fee that you're going to get charged if you have us do it for you.
And as employers, I guess that's one thing that we would, offer that you may want to think about is if it's just a direct deposit. So just like your employees have their bank anywhere and they have their direct deposit anywhere, by forcing them into one, HSA, that may be a deterrent for them. So you may want to just say it's just setting up direct deposit just like it is for their paycheck, letting them choose where they want to go, where they have a relationship, or suggesting here's some options for you, but not forcing them into one specific scenario of a bank.
So there are a lot of advantages of HSAs. I'm going to go through these. Please, again, stop me if you have questions as we go through. The nice part about the HSA, and I guess kind of the scary part for year one, is that you don't necessarily have anything built up yet. If a company does a contribution, what I found is that you will have a lot more buy-in from your employees as far as going to a high deductible health plan and taking that free money. So after your in a high deductible health plan and you have an HSA for a few years, you will have money built up in this account. So the HSA can protect you from medical expenses that you didn't expect. I know when I started with KeyBank, I was used to the HRA, so I was like, there is no way this money is going to roll over year over year. I'm only going to put $5 in a paycheck because I don't know what my medical expenses are going to be, and I don't want to lose my money at the end of the year. And as the years have gone on, I've actually played the game a lot with what the difference is, because KeyBank only offers us 2 different high deductible health plans, a lower high deductible and a really high one. And there is a good difference in what we pay on a paycheck between the two. It's about $50 between the two. And if you don't meet the $2,500 deductible ever, what's the point of being in the one that's costing you $50 more a year? So the other option is we have a $5,000 one. So basically what I did is I took the $50 and I put it in my HSA so that I could build that up, and I went with the higher high deductible, the $5,000, because I didn't come close to $2,500, so why am I going to throw my $50 away every single paycheck? So once you get into that routine, you can really build up a substantial amount of money in your HSA so that when something bad does happen, you have that money available to you.
And that's what we suggest, is that they look at what they're paying right now out of their paycheck for their premiums and what the difference is, and take that difference, because you were used to paying that, and put that in your HSA every single paycheck. So it feels the same, but then when you have something happen, you've got the money in the HSA. And I was in a similar situation, because we do have some, medical issues within the family, prescriptions monthly and different things like that, so we were concerned. But it was amazing that after the first year, even though of course my daughter had to have surgery the first year, we were in the high deductible plan and we paid out of pocket, but after that year, everything that's happened, we've had money in the HSA because we just keep, we don't think about it, it's money that goes in, just like your 401k money goes in, and you don't think about it, it just goes in, and the money's there because it's sitting there growing and building, because you're putting in that difference.
The other thing I would say is at the end of the year, all your employees should get an explanation of benefits from their insurance provider to show what they've spent in medical expenses. That might be a great tool for you to, as you're doing your open enrollment meetings, if you're offering more than one plan and you kind of want to steer people the high deductible way, have them bring that. Have them take a look at what they paid. And does then it really make sense for you to be paying, maybe if you're on family coverage, $300 to $400 a year for that copay plan if you're not really utilizing the benefit of it? I mean, obviously if there's illnesses or prescriptions that wouldn't be covered, then you know what, you're probably going to have to deal with it and pay it. But if you're a relatively healthy family, there's no reason when you look at that explanation of benefits that it would make sense for you to not look at a high deductible health plan. So the clients, anyone who opens a HSA can use their money to a certain degree however they wish. So if they want to save it for later, they can. If they want to use it this year because they need to, they can do that. As long as it's used for qualified medical expenses, they control how they use that account. Most health savings accounts are going to offer you debit card options, online banking options, check options, so that you have the ability to pay your bills once they come through. Each individual employee and each individual employer, if you have a high deductible health plan and you want to offer an HSA, can set up how they want to do it. So if you've got an employee who's kind of paycheck to paycheck and they can only do $5 or they can only do $2, they can just do that amount until they get more comfortable with it. As an employer, you can set how you want to contribute to the HSA. If you have large turnover, and you're a little bit worried of taking the jump from an HRA to an HSA, you can actually set it up so that each paycheck, an employee will get a set dollar amount based on what you want your total contribution to be for the year. So, for instance, I'll use KeyBank as an example. When I first started with the bank, as a family, you can get $1,000 if you do all the things they talk about down there.
All the healthy activities,
The biometric screening, all that. So if you do that and you submit all the documentation to KeyBank by September 30th, as a family, I can get $1,000 contributed into my HSA. The first 2 years that I was with KeyBank, they did that per paycheck. So that way, if I left the bank, they're only out the money they've already contributed to me. And at that point, I think it was like $40 a paycheck, which is okay, but it's not great if you have a medical expense, because $40 if you have medical expense in January, you're kind of in trouble, because $80 isn't gonna get you very far. And then more recently, they've actually switched to, they do our contribution in the second week in January. So we'll get our $1,000 the second week in January, and then we're able to use it for the year. You can also set up, I've worked with companies that do kind of quarterly prorated. So you may get, in January, if they wanted to do $1,000, $500, and then the next quarter you'll only get $200. They kind of, so if you lose someone mid-year, you haven't given them the entire $1,000, but you're able to set that up however you want as an employer. And the employees, obviously, as an employer, you can tell them how you want them to do it, whether they can only, KeyBank only allows us to set what we want to put into our HSA once a year, and then we're stuck with that dollar amount for the whole year. But again, you can adjust that if you want to allow your employees to do that. We kind of already talked about this, but you're able to bring your HSA with you. It's not a use it or lose it. If I stop working for KeyBank, I can bring my HSA to my next company. If they're on a high deductible health plan, I'm still able to contribute. If they're not, I'm not able to. So with the HSA, we do get tax savings. So tax deductions when you contribute to the account, it's not a straight, I contributed $1,000, so now my income went from $50,000 to $49,000. It's not a straight kind of tax deduction like that. You also are able to take money out, tax-free if it's for medical, and then any interest that you may earn on the HSA or on your investment account, you do not pay. It's similar to a 401k where you're not going to pay capital gains on any of that. So this I wanted to share with you. So if you decided that you wanted to do a company contribution to an HSA with a high deductible health plan, these are some of the savings that you can get based on the insurance rates. So even taking, compared to the copay plan, if you contribute $500 to your employees, you're still saving about $700 per employee. And if you did 1,000, you're saving almost $2,000 per employee compared to offering everyone the copay plan and not having any sort of incentive to go into the high deductible with the HSA. And I just wanted to close with this, and then we are kind of tight on time, so I'll see if anyone has any questions. These are some of the benefits of KeyBank HSAs. The one thing I will say is whenever you're looking to offer an HSA, make sure you do your research. Because they're similar to IRAs, there are a lot of fees associated with them as far as setup fees, annual fees, minimum balance requirements, and a lot of banks, you may not realize that because you're thinking it's just a basic account, I should be able to go in and get an HSA. With KeyBank, you are able to get them for free if you set up a group code with us. If you do not, so if your employees walk into a branch, there's a $25 setup fee, a $25 annual fee. There's the fees associated with that.
Unless they already bank with Key.
Right, unless they bank with Key. But just saying, you tell your employees, okay, go out to these banks. These are banks that offer health savings accounts. Do your research first. They're all going to have fees associated with setups, investment options. The most common one that really not going to avoid unless you set up online statements is the paper statement fee. It's not going to be eliminated with any bank, but every bank is going to charge you a fee to just get that account set up, and an annual fee if you're not establishing some sort of relationship with that bank.
And it's really easy to get the company code. It's one form. You don't have to bank with KeyBank to have that. So you just fill out a simple form. We fax it in. I did one for a client this week, and I had it the next day. I had the company code. So there's no strings attached to you as an employer to be able to set up that company code and say, now you can go to KeyBank for free to be able to get those accounts.
The other thing I will just say is, if you guys work with brokers for your insurance, a lot of them will help educate your employees on health savings accounts. We would be more than happy to come in and also educate your employees. If you don't position the health savings account on the HSA correctly, or the high deductible health plan on the HSA correctly, you're not going to get people to buy into it because it is very scary. As far as, okay, my deductible is now $1,300, what happens if? So you've got to really explain the benefits of the down the road, the option to invest, the option to have money for retirement.
We have a lot of small businesses that they will actually use the HSA retirement vehicle and just pay their medical costs out of pocket if they can, so that they have another bucket of money for retirement. But then if something catastrophic happens, it's there and they can use it for that. So it really just depends. But I think like Jessica said, if you explain it properly or bring us in, we're happy to come and talk and just explain how it works. That's the big thing. I had 2 companies this week that we've talked about it, but they just didn't have time and they got crunch time, and now they just, rolled everything out to the employees, and nobody's choosing the high deductible plan because they didn't explain it and there was no one there to educate them. So we can help with that.
I have a question. Can you, if your employer offers the HRA and they contribute to that, can I as an employee do an HSA also? Or, okay, so it's just like this?
Well, that's a yes and.
Yes.
Because you can set up the HSA where the employee would have to pay the first $1,300, then the HA.
Right, but the problem is that the employer is contributing from the start.
Can't do that. correct?
Yeah.
Right, that's what I'm saying.
Yeah.
So if your employer is already gonna give you $2,000 from the start of the year, no, you cannot have an HSA.
Right.
There are ways to couple them, where you have an HSA and then post your deductible HRA. But most employers are set it up as you have an HRA. So if you have an HRA, the general answer is no, you can't have an HSA.
You wouldn't want to contribute to an HRA yourself because you lose it.
Use it, yeah. You can, yes, it's employer-based.
I think I saw that this is a federal law, so you can transfer to a different state and have your account follow
Yes.
you. That's different from a lot of the other businesses.
I mean, it's portable, so you can move, you work for a different company, the company offers high deductible health plan, it's your account, similar to like you have a checking account. It's part of it is ease of use, so if you're in New York now, you open an HSA with, say, Key Bank, and then you move to Florida, we don't have a branch, you may want a local HSA, but yes, you can, it moves from state to
Well, I think
state.
that's a selling point for some companies that operate in multiple states.
Right,
Absolutely.
exactly.
And even though we're not there in another state though, with online
still-
and
it's all
everything
online
else,
banking.
they can still keep it, so.
What advice do you give to people that have creditor issues and when they open accounts, those accounts tend to get frozen or confiscated?
The HSA cannot.
Are you sure?
It's similar to an IRA, so.
Because I've had it happen. So, and the answer I was given was that if it was court ordered, the court can overrule on anything. So, have you ever had an instance where somebody that owes federal taxes has had the money confiscated? 'Cause
I have not seen that in an HSA or an IRA ever. But certainly we're not attorneys, but yeah, I mean, I've never seen it be, that money be held.
So
up
they
like
can't
that.
come after for child support or anything like that?
No.
No. And then like the other part about the HSA, is you can't overdraw it. So you can't swipe your debit, like you can overdraw, you're not gonna get fees associated with it, but the catch is that if you do overdraw it, the bank will shut your HSA down.
I said it.
They're giving us that we need to finish up, but if anybody has any other questions, we're downstairs, we have a booth, certainly stop by. Our cards are down there if you have any questions, we're happy to help, so, thank you.
Thank you.
Hey, Christie.